So I've met Vasu and Patrick. Hi, Henry. I don't think I've met you before, but my name is Angela Roscoe, and I am your sales executive for Fidelity National Title. And in addition to closing your escrows and providing you with our resources that we offer, I'll be bringing in different speakers throughout my partnership. And with me today, I have Andrea Papp, who is a CPA. I mentioned earlier, she is very popular in the real estate world. And very high level. So I thank you for being here today, Andrea, and just giving us your time and your knowledge.
Thank you. So I wonder, within the folks in attendance, how many are new agents and how many have been in the business for a little bit?
I know Patrick and Vasu are new. Henry, have you been in the business for a while? I don't know about Henry.
Okay. All right. And Stacy, is Stacy?
She's been in the business for a while.
Mm-hmm. Okay.
Yeah.
Well, I will, as long as I have rights to share my screen, which it looks like I do. I will share my screen so you're not staring at me the whole time. And let's see, do you all see my screen?
Yes.
Okay. A little bit about myself. Angel said that I have a background in real estate. Some of you heard me saying I went to Santa Clara University. I started my career in public accounting with an internship that moved into a full-time role in the tax department at Frank Bermerman, which is a local regional firm. And they service, their niche is high net worth families and individuals. So, and this isn't privileged information. Some of the returns I worked on are the Sobrato family, the Mozart family, the Perry Aralaga, really big real estate families, really big developers. I went to another firm called Abbott Stringham and Lynch with a very similar clientele before I started my own practice. My college job was working for the controller at SCORE at the board. So I've kind of come full circle, and real estate has been around and a part of my career in my life for a long time. I put this at the top of all of my presentations that you all should have made a fourth quarter estimated payment back in last month, January 15th. If you haven't done so, it's not too late. They will gladly take your money anytime you give it to them, and payment of your estimate stops underpayment penalties from continuing to accrue if you're not current on your quarterlies. April 15th is our filing and tax payment deadline for 2020 tax returns. It's also when our first quarter 2021 estimates are due. So if you can imagine, let's say you have a balance due last year because you didn't stay on top of your quarterly payments. So you have to pay your 2020 tax bill. You really should be paying your first quarter for 2021. If you're a homeowner, your second installment of property taxes are due in April, plus your retirement contribution. Unless you extend, you need to come up with that cash to fund. So April can be really expensive, and it's a lot I prefer personally, and help my clients even out their cash flow. So April is not this humongous cash outflow. Coming up June 15th will be our second quarter estimates, and so on, September and January. October 15th is the extension deadline for those who file an extension to give themselves time to fund their SEP, their retirement. That's due October 15th. I'll cover some of that, more about the extension, the SEP later. I wanted to touch here on Prop 19 because I'm getting a lot of questions. I'm sure Angel is getting a lot of questions. You guys are probably getting a lot of panicked questions. And I think I've spent more of my time, I would say, talking my clients off the ledge of being panicked. So I'll explain kind of the nuts and bolts. You're familiar with the old law that you could transfer your property tax base for 55 and over, equal or lesser value, one-time transfer to only, last I checked before this expired, 11 participating counties. So this was limited. One time in your life, once you reach 55, within only a few participating counties. What expanded in Prop 19, and this is what Carr fought for in the expansion of this proposition, is that you can keep your property tax base regardless of how much you buy.
So the transfer amount won't change, but you're not limited to that equal or lesser value anymore. You can buy what you want. You can do this now up to 3 times in our life. And this is statewide. So there's not a handcuff on staying within a few counties. And once you reach 55 and over, you can do this transfer 3 times. So this part of the proposition is extremely beneficial for almost every California homeowner. I think that's why this proposition has been kind of a little almost slanderously referred to as the real estate agent proposition, with this idea that this is going to, and it might, free up inventory and create some sales where people that were worried about moving because they didn't want to go to one of those 11 counties are ready to sell now. So this was the part of Prop 19 that was expansive and beneficial. What California said was, we're losing a lot of revenue on this, and they have been. I don't know how many of you have heard this referred to as the Lebowski loophole. That refers to the actor, Jeff Bridges, from the movie The Big Lebowski. He inherited his parents' Malibu beachfront home and is still paying mom and dad's 1970s property tax bill. A lot of people are quick to say, well, he can afford his fair share of property taxes. And that's what this cost has been to California. So the offset to this is that the generational transfer no longer retains that dollar for dollar absolute property tax transfer any longer. The old law that we're familiar with is there was no value limit, and you could transfer the entire property tax base to your kids. Here's what the new law says. It still is parent to child or grandparent to grandchild, meaning if that middle generation has deceased. And this was effective 2 days ago. So this is now the law as it stands in California legislature. Generational transfers will retain the property tax base plus $1 million of exclusion. After that original property tax base transfer plus $1 million of exclusion, after that, the next dollar is then reassessed for a new property tax bill. This has to be transferred to a child that retains that home as their primary residence. So the $1 million exclusion on that property tax reassessment only applies if the child inheriting lives in that house as their primary residence. And I've heard a lot of people say, well, who's going to know? How is anybody going to know? First answer is it's tax fraud if you lie about it. But there's a lot of ways that they can look at this. Where are your utilities registered? Whose name is registered on, like I said, on utilities? Where are your cars registered? Where's your driver's license registered? If you inherit it and you claim you're living there but you rent it, you should be filing a Schedule E, which means it's not your primary residence. So the idea that I think some folks had that there might be a way around this doesn't work, flat out.
I mean, the first answer is that's tax fraud. Second answer is they're going to know. And the risk of penalty is not one that anybody is worth taking. A lot of the FAQs of this proposition are still being written because it just passed in November. This was probably a little hastily put together. So California legislation is still writing rules and guidelines around enforcement and FAQs. So there are still questions that we don't know how to answer. For instance, mom and dad are gone. They have 3 kids. Only 1 kid is going to live in the house. So what happens to that $1 million exclusion? Do they get it in 1/3, or do they get the entire $1 million because they reside in it? More likely than not, common sense says the $1 million should follow whoever lives there, but these are issues that have not been completely sorted out yet. This is an illustration of a home that the person inheriting is going to live in as their primary residence. So mom and dad's property tax base was $300,000. The home is worth $2 million now. I'll just go through the second column. Mom and dad have been paying $3,300 a year in property taxes. So under the old law, that's what would have transferred, but no more. So we almost have to pretend that doesn't exist anymore. What is happening now is they are going to get reassessed up to $11,000 a year. So there's a $7,700 annual increase in property taxes. Now, the knee-jerk reaction is, that's so much money, that's so expensive. How can I afford to keep the house? And what I've been asking folks to do is take a step back and evaluate. Do son and daughter already own a home? Maybe their property taxes are similar. Let's say they bought a home for about $1.5 million in San Jose, and they inherit mom and dad's home in Saratoga. Their property tax bill may be similar, and mom and dad's home may not be encumbered by as big of a mortgage as the child inheriting the home. So big picture, looking at the economics of what the payments and costs associated with inheriting a home are compared to what they currently have. On principle, because we're used to having that property tax transfer, it feels like a grab, and it is in terms of the cost of inheriting that home. But inheriting real estate is not a burden necessarily, right? There's probably equity in mom and dad's home, probably has a pretty low mortgage. So when considering all of that, the cost of that new home, even with a bump in property taxes, it may look different in light of all of those other considerations. So this is what I've been chatting with my clients about. Attorneys that I work with go through this same scenario because it is, like I said, it's emotional and people don't understand the calculation, and every calculation here is different. Everybody's situation is going to be different. So this is not a one size fits all answer or even factors to consider. On a rental property that's inherited, so mom and dad have a few rentals, child inherits the rental property, there is no $1 million exclusion, so the entire value will automatically be reassessed. So even though mom and dad have a pretty low property tax base, the new property tax base will be reassessed to fair market value at the time that it's inherited. So this is where cost is going to increase dramatically. Depending on the cash, and this is, again, a lot of factors to consider. Let's say this has been, quote unquote, a legacy property. Let's say it was grandma and grandpa's house that mom and dad inherited. It probably has a pretty good cash flow. So by the time the child inherits it, even with a pretty significant, very significant increase in property taxes, there may be cash flow to absorb it. Now, what's going to happen is the immediate cash flow will absolutely be cut in, who knows what, maybe even half for some properties. Well, what I've also been pointing out to clients is rents are not going to stay flat. So whenever they inherit a rental property, they have to plan for that adjustment to cash flow because property tax is going to get reassessed. But over time, rents will increase. So that cash flow will go back up. Now, if the increase in this property tax really does not make sense to keep the rental property because the property already didn't cash flow, then that is something to consider for selling, maybe transferring, but I say maybe because there's a few other things to consider here. Probably for the last few weeks, a lot of your clients have been saying, should we transfer our property? Should we gift our property to our kids to keep the property tax value? The answer was typically no. With all of my clients, with all of these state attorneys I work with, the only folks that were doing those transfers were legacy properties. So properties that have been around, little to no mortgage, extremely low property tax, and a pretty solid cash flow, or a legacy home that's a residence. So legacy properties may fit the criteria if, and this is first in line for a reason. The most important question to ask is there a possibility that the kids will sell an inherited property in the future? And nobody knows the future, right? For a family whose children are in high school or college, they don't know what their children are going to do with an inherited property. They certainly aren't ready to be landlords. They probably aren't ready to take over the home, worst case scenario, if they inherit early. Young children, nobody knows what's going to happen. For adult children, let's say they're siblings, and this is consensus among the estate attorneys that I work with. More often than not, inherited properties end up being sold. When they're siblings, do you really want to wait and file your tax return with your sibling every year because you have a rental property that you have to report on both of your Schedule E? People aren't interested in being landlords. It may be more hassle than it's worth, or there's a lot of cash, a lot of equity sitting in that property that they would rather take and invest and do with what they want. So more often than not, the inheriting generation sells. If that's the case, transferring real property creates gift and estate implications that are far more costly than that increase to property tax. I don't have a slide here to illustrate this, but property taxes, I'm using 1.1% for this conversation. So they jump, the entire value is reassessed up to 1.1%. That's only for property tax purposes. For income tax purposes, when you gift real property, you are gifting your original cost basis. So that home that mom and dad bought for $300,000, when the kids inherit it and it's worth $2 million, they have to pay capital gains on $1.7 million. Whereas before, you may or may not be familiar with what's called stepped up basis. When we inherit real property, the income tax cost basis steps up to fair market value. So if they inherit that property and it's worth 2 million, they sell it for 2 million, they have zero capital gain. Capital gains rate, let's use 35% for conversation. In that scenario, the $2 million scenario that I ran, it would take almost 90 years to recoup the cost of income tax that the child would pay on selling a home with gifted tax basis, rather than keeping the home and paying that incremental property tax. So I know there's a lot here to consider. Another thing to talk about when people say, well, mom and dad should transfer me their house so I keep their property tax basis. First of all, and this is, I don't mean to be crude or flip, but it's not their house. The parent, the person who owns the real property, has to start that conversation. A child can't go to an estate attorney and say, hey, you know what, my mom has really low property tax basis. Let's start drafting up papers to gift it over to me. There can be cases of elder abuse there if mom and dad aren't aware of what's going on. It is not their property to take. And there's other things to consider here. Mom and dad may still need that write-off in their income taxes. When they gift real property, they give it away. They no longer own that home. So they now are essentially paying rent to their children. They don't write off the property taxes or mortgage interest. If it's a rental property, they do not have right to collect rent anymore. And what if that rental property is part of their retirement income? Gifting that property now means that the kid picks up and reports the rental income in their tax return. So gifting real property is not just something that you do on paper. It has very real legal and tax consequences that for most families does not make sense. So a lot of my clients, and I'm sure yours too, are feeling panicked about this and feeling a little intimidated because there is a cost associated that it's out of our control. But there is a lot to consider, and whether it's talking to someone like myself or an estate attorney, will walk them through a lot of these considerations. Would anybody like me to keep talking about Prop 19, or I can go into some more income tax planning for self-employed agents?
I have a question, Andrea.
Yeah.
It's with taking once you're over 55 and taking your tax basis with you, are there any type of loopholes for a married couple, one who's over 55 and one who's younger, to take that transfer with them to a second home?
A second home. I will have to say here that I am not aware that that is qualifying. It does have to be a primary residence. Probably also, I would imagine that the FAQs and guidance that's pending will address that, but I can't, yeah, I'm gonna say I don't know. I don't have an official answer. I would imagine not the case. I would imagine not the case.
Okay, thank you.
Andrea?
Yeah.
Okay, thank
Hi,
you.
Patrick. Yeah.
Hi.
Patrick.
Hi. This is really good information. So my situation, let's say we have 2 investment properties in no primary residence. I own property, I live with my partner, but these are not my primary residence. So if I were to, I'm just kind of backtracking here and make sure I understand. So I something happens to me, the homes get left to my nephew, he's going to, because they're investment properties, he's not going to get that $1 million exclusion, correct? That's
Correct.
just, it's gone, because for me, they're investment
Correct.
properties. That's just the way it is.
Let me jump in. If he
Cool, okay.
decides to move in, if he decides to
Sure.
move into one, sorry, I'm getting feedback or kind of background noise. If he decides to move into
Here, let me,
one, he would convert that to a primary residence and then get $1 million, but it would be a property that he would be interested in actually living in and converting. So go ahead.
so that's an option. If he chooses to move into the house, then he can benefit from that. All right.
Yeah.
Thank you.
How long would he have to live in that house for?
Good question. More pending information from California legislation on, we have no way of knowing how they're going to follow up on that enforcement. So it's anybody's guess right now. At some point, we don't know. The estate attorneys and real estate attorneys are probably going to be the first to get information. Once California writes those laws and once each county assessor has enforcement and guidelines, we will all know and we'll all be reading about it, but we're in the same boat right now. We don't know the answer to that question either, but that's a great question. I would add to something that Patrick mentioned. Anytime you or your clients, well, actually, I shouldn't even limit it to real property. Everybody should own their real estate in a living trust. Owning real property and not having a living trust, when you die, that's called dying intestate. Without a living trust, real property goes through probate. That is expensive. It is a long administration process. So anytime you own real property, there really needs to be a living trust in place. Yeah, go ahead.
One other question. The last time I asked this question, it was, again, they weren't sure yet. They're still trying to get clarification. But if you have a sale that's starting now, it closes before April 15th or whatever that deadline is, April 1st or April 15th, can they still qualify to take their tax basis with them outside of one of those 11 counties?
So outside, to the best of our understanding, if it closes before the deadline, they're limited to the 11 participating counties. They can still take that transfer under the old law, Prop 1690. If they can, extend close of escrow, work with the lender and the other side on the transaction, get it to close after April 1st, then it will be under new law, new Prop 19.
So both sides have to be after.
Yeah.
Okay, thank you.
Yeah.
Question, please. Yes. So for, say the parent has primary residence and rental properties as well. And so if the child is inheriting both the properties, will they have a choice as to which can be a primary residence and which they can transfer that $1 million exemption tax base? So I hope that makes sense, the question.
It does. And yes, the child can choose which home to reside in as their primary residence. And that home would keep the $1 million exemption. Yeah, good question.
So the other property will then have the new tax basis.
Correct. New, okay. And I want to clarify, new property tax basis, because there are two different kind of tax conversations going on at once. There's the income tax cost basis and the property tax cost basis.
Okay, one supplemental question in that case. So how would the tax implication change if, say, if the property is in trust versus not in trust and the transfer happens?
It's the same result. When you inherit, whether it's in trust or not, but it should be in trust, the income tax basis is fair market value. So the income tax cost basis gets stepped up to what it's worth today.
Okay.
Or at the time of passing.
Okay, thank you.
So anybody want to weigh in or jump in with any more Prop 19 questions, or I'll move on to Schedule C and being self-employed? All right, oh yeah, go ahead, Patrick. You're still on mute though. Okay. So I know I covered this already. I tell this all my clients. I probably sound like a broken record. Stay on top of your quarterly estimates. I'm going to come back to this one more time, but they can be paid online. It is as easy as sending in your money. There's no pomp and circumstance to file anything. There's no official form. There's no paperwork to fill out. It is our responsibility as a self-employed taxpayer to determine how much we owe. I use, for conversation purposes, 30%. 30% of your income, net income after expenses, should be set aside and sent in as a quarterly payment. I'm going to come back to this because it's costly not to do so, but I will come back to that. Right now, February, really last month to January, if you paid any vendors more than $600, that's an individual, you need to have issued them a 1099. A lot of people think of 1099 as a 4-letter word. It's not. The person who received the payment, they have an obligation to report the income, just like we have to report our income. All taxpayers by tax code, we have to report our income, whether or not we were 1099 or not. Issuing a 1099 protects our deduction. It is statutory and required that when you pay an individual more than $600, we must 1099 them. Let's say in a random correspondence audit, the IRS says, you know what, I want to look at your assistant expense. That's a pretty big expense line item on your Schedule C. Did you issue that assistant a 1099? If you didn't, they can disallow that expense because you are out of compliance with the 1099 filing. The deadline was technically January 31st, but you can still file them today or tomorrow or whenever you get this ready, but they do need to be filed. And like I said, the person receiving the income, they were supposed to report the income regardless of whether you 1099 them or not. So if you're getting pushback from somebody, that's a good clue they're not paying their taxes. And you're protecting your deduction. The second line item here I'll chat about in a little bit, PPP, Payroll Protection Program loans. I think a lot of us in this meeting were new agents, so this may not have applied because you had to have had profit in 2019 to apply, and our net Schedule C is what they considered payroll. So as a self-employed person, we don't have a wage or a salary, but our net Schedule C is our payroll for purposes of the payroll protection, the PPP. The application can be started now, depending on your lender. Interest has been accruing since the date of disbursement. So the longer you wait to apply, depending on the value or the balance of your loan, that could be a meaningful amount. And then once it's forgiven, there's no strings attached, except, I should caveat that with, there's no strings attached in terms of it's not taxable income. You don't have to report it anywhere. Right now, California does not conform to federal PPP loan treatment. So does anybody in here have an S Corp, or are we all Schedule C filers?
As we have an S Corp.
Okay. If your S Corp took PPP, please file an extension. There is AB 281 is legislation introduced to California Congress. The governor just announced today that they are moving that forward, but what that's doing is it's ideally, fingers crossed, going to make it so that California conforms to federal treatment of PPP loans. If you file that S Corp, and by the way, this part of the conversation doesn't apply to Schedule C. I'm only talking about S Corps with PPP. Filing today means that you have to add back the PPP loan amount to taxable income for California purposes. What they're trying to fix is to eliminate that add back so that it's not taxable. So extending the S Corp, which means extending your individual, to allow time for California Congress to pass that legislation and then file under new laws. It's going to save you time and money of amending your returns and dealing with that headache. Moving on, more kind of best practices here. Always set aside, I'd say, 25, 30% to be conservative for quarterly estimates. Also, budget for your own retirement. Part of being our own employer is that we are our own CEO, we're our own CFO, we're our own COO. You want to pay yourself and you want to pay yourself into retirement. So budget 20% for your SEP IRA, and I'll cover that in a little bit. Kind of year-end, kind of best practice, what I talk to my clients about is go through your bank statements, go through your credit card statement, and really reconcile them and look at all of the recurring charges. A lot of times there are subscriptions that we signed up for that we've abandoned that platform, duplicate subscriptions, things that we might not have even ever signed up for. An easy example is within one household, you may have 3 people paying for Netflix. So go through your statements, because those automatic recurring charges, it's easy to forget that we're even spending that money. So make sure you know where your money is being spent, where your committed costs are. And if you don't already have QuickBooks, I recommend QuickBooks for almost everybody. You can sync up your bank account. You should have a separate business account, so no commingling. I might come back to commingling in a little bit. The problem with an Excel spreadsheet is it does not fill itself out. And best of intentions, you may miss a week, a 2-week period, you miss a month, and now you've got 4 months of expenses to keep track of, and who wants to sit down and spend 3 hours doing that? QuickBooks somewhat runs in the background. Once you sync up your account, it becomes predictive. It learns what expenses are what kind of categories. So it knows that your Opticom is going to be signs or advertising. It knows that Zillow is advertising. It knows where your dues are going. So it is a fabulous tool. It's not that expensive. I think it's $10 or $12 a month. And it makes your life so much easier for running a real-time income statement, so you can figure out how much money you've made, to make a quarterly payment, to know if the money that you've committed to a certain marketing expense is worthwhile. Right now, January, February, some of you are probably, avoiding or frustrated with going through your income and expenses for your tax return. It's all in one place in QuickBooks. I know it sounds like I work for QuickBooks, but they've been around a long time for a reason. It's a product that works, and it's a really good tool to have in your business. Mileage tracking, we are all entitled to write off business mileage. And the reason I bring this up this year is, even though the IRS is a big government agency, they do use some common sense. And in a year of COVID, where we have been mostly shut down, to tell your accountant, oh, just claim miles same as last year, not appropriate. The IRS system in e-filing, they look for consistencies and they look for inconsistencies. This would be an area that I would imagine, if we're all claiming mileage based on what we drove last year, that would be a red flag that you're probably not keeping a mileage log, and you probably are fraudulently claiming too much mileage expense. We weren't going out, we weren't driving around, we weren't visiting clients for a lot of the year. And also, once you get in that habit, you may be missing a mileage deduction if you start tracking your actual mileage instead of just kind of going, yeah, I'll eyeball it and say I drove about 12,000 miles last year. What if you had a lot of buyers and you were in the car and you drove 18,000 miles last year? So you don't want to leave it an expense on the table that you're entitled to. There's apps that you can buy, you can put on your phone that runs in the background. Mile IQ is a popular one. QuickBooks has one built into its app. You set rules where you can even say, from here to Trader Joe's is personal, from here to, daycare is personal, and then it prompts you for all the other trips, so you can make it easy on yourself. And again, that kind of runs in the background. I've covered a lot of this here, but making sure that you know where your money is going, tracking your expenses, because it is very easy to sign up for a program or sign up for a product, forget that it's on auto renewal, and then you just pay your credit card or it's automatically drafted. Companies, and being self-employed, we are our own company. Companies have controllers and CFOs that audit every single line item, every single month. It gets reconciled. So make sure you're doing the same for yourself. Make sure you stay current on your tax payments. It does cost you money to not pay your quarterly estimates. And I know there's a lot of feeling around, I want to hoard my cash. I don't know what's going to happen. The fact of the matter is it's not your money. As self-employed taxpayers, we are obligated to make our quarterly taxes quarterly. If we were on a W-2, the employer would be paying those quarterly taxes for us, the payroll taxes, but it's our obligation to do so. So the cost of not doing that is we're taking a loan from the IRS and the Franchise Tax Board, and you bet they charge interest. I'll come back to that in a little bit. Commingling for your own time saved and administrative ease, it is a lot cleaner to keep things separate. And I know as a Schedule C self-employed taxpayer, the lines are blurred. Our business rolls over into a lot of areas of our life, but as much as possible, use one card, dedicate one credit card, one checking account to your business. And if I don't think there's any lenders here. In November, Fannie Mae and Freddie Mac issued in LL 2020-11 lender letter, November 2020. They are now saying that you cannot commingle, or they're going to go through your bank statements as a self-employed borrower. Let me back up. As a self-employed borrower, they're going to look at 2 years average Schedule C, look at your tax returns, and now they want to see 3 years of business bank statements. If there are personal expenses in those business bank statements, they can reduce the amount of income that you're applying, that you're using to qualify, by those personal expenses. This is in response to COVID. A lot of self-employed borrowers, and I'm not just talking about here in the room as real estate agents, I mean, this extends to your self-employed clients. Self-employed people that took PPP loans, what that is essentially saying is, I was unsure of my own business profit. I needed a PPP loan because I didn't know what was going to happen. Now, from a lender's point of view, they're going to take that literally and go, well, if you took PPP, why should we feel confident that your income is going to continue? So this updated November guidance from Fannie Mae and Freddie Mac is in response to them being cautious about self-employed borrowers not having the income that they're saying they have to qualify. So this could be happening with some of your self-employed borrowers as they're getting in contract with their lenders. This could happen and come up for you as you are buying or refinancing your own homes. So best practice, keep a separate business checking account. I said all that to say, do not commingle, keep a separate business account and a separate personal account. Subscriptions I've covered already in terms of knowing where your expenses and those automatic charges are going. And savings and profit. What I mean by this is know how much profit your business is making. And of that profit, some of that is your own compensation. So you have your own mortgage to pay, you have your own car payment, you have your own tuition, groceries, etc. You also want to pay yourself into retirement. Nobody else is going to do it for you. So set aside that 20% to put into your SEP IRA, and then pick an amount to keep invested in the business, right? You never want to drain your business checking account. There's going to be expenses that come up, could be a few weeks before you close something. So keep money invested in your business, pay yourself and pay your future self. And all of that comes back to knowing how much money you've made, which QuickBooks is a really good solution to that. I've covered a lot of this, so I'm actually going to skip this comment. If anybody has been listening to the news that there's a second round of PPP available, there's some caveats. In response to the first round, and you remember in the news, a lot of businesses took it that probably didn't need it. Some businesses put it back, gave it back because they definitely didn't need it. SBA has now created some need-based requirements saying, if you are going to apply for a second round, you need to show a 25% reduction in your gross receipts from last year, Q1, Q2, or Q3. Now, if you don't have a method of running an income statement by month, how are you going to do that? Probably not very easily. If you are going to do this, you have to have done it before you apply for forgiveness on the first round. Probably that's the case for most people. Applications for forgiveness have been so slow and not really applicable here, less than 300 employees. But this one is probably going to be for some folks, it might be hard to reach because I know some folks had benchmark years last year, and some folks had, you know, the year stalled, but QuickBooks will help determine that. So I know I said I sound like a broken record on your quarterly estimates. I will cover some of this pretty quickly. This is the cost of not sending it in. If you've been in business for a while and you think, well, I don't think I'm paying it, check again, look back at your prior year tax returns. I can't remember the exact line number, maybe 64 or 66, somewhere on the bottom of page 2 for federal, page 5 for California. You may be paying some underpayment interest and penalties, and they already take enough of our money, so why give them more? Remember, like I said, it is not your money, so any money that you don't pay on your quarterly, they're charging you interest on keeping it because the IRS and the Franchise Tax Board, they want it. If your accountant is not asking you about annualizing your income, bring it up. What this means is, let's say you had a really quiet first quarter, you closed 3 things in Q2, 10 sales in third quarter, and nothing in fourth quarter. You can show the IRS how your income was earned and explain and show, well, here's why I didn't make a first quarter payment. Here's why I made a second quarter payment of X. And here's where I needed to make a big third quarter payment and nothing in Q4. So you can tell the IRS in California what quarters you made your money to also avoid those underpayment penalties for being underpaid for the whole year. The due date here, again, I put that up here. For those of you who are looking at a calendar, the IRS has their own idea of a quarter. It is not an even calendar year quarter like we're used to, but this is the payment deadline for quarterly payments. This slide is pretty redundant. QuickBooks here, if you don't take anything away from today besides pay your quarterly payments, sign up for QuickBooks or some method that works for you. I'll caution you against some of the free versions. I think Wave has a free accounting system. You pay for what you get. And I have some clients that were on Wave and they got off of it within about a year. QuickBooks, like I said, it's been around for a long time. It works. It's trustworthy. And that commingling thing is really important to avoid. This slide, I don't mean for you to take notes here, but a question I get a lot is something a write-off? Can I write this off? So I ask the question, did you spend that money with the intention of generating business? Did you pay for something to promote yourself, to network, to get a client? And a lot of times the answer is yes. And I don't mean to be egregious and make things up or take every single dollar that your household spends and call it a business expense. That's not appropriate. That's not what I mean. But when you frame the question in that way, a lot of what you're spending probably does have some business purpose. So keeping things well documented, keeping it running through your business account is very helpful here. I have covered this slide already. This references the Fannie Mae notice that they issued in November about the self-employed borrowers not commingling. This slide doesn't apply right now because we're out of open enrollment, but we do have a requirement to have health coverage. And I know that sounds like, well, why does that matter for income tax? California has a penalty for not maintaining minimum health coverage. So you do still have to have health insurance, even though the Affordable Health Care Act has been kind of pulled apart in Congress for a lot of political reasons. The federal penalty is gone, but California still has a penalty. When open enrollment does come around again, remember that Andrea said to look into a health savings account. And I'll leave it at that, but you can do some research later. Your SEP IRA, if you don't already have one, you should sign up for one. You've probably heard all of your peers talk about funding their SEP. It is the most common self-employed retirement vehicle. It is calculated at 20% of our net Schedule C. There's a few minor tax adjustments, but just plainly speaking, 20% of your net Schedule C. It has a cap, $58,000 this year. So if your net Schedule C was well above $200,000, you'll reach the cap of your SEP. This is a tax deductible contribution. So you're reducing your taxable income by the amount that you pay yourself. The benefit of putting money into any retirement account is that you enjoy tax deferred growth on earnings. So let's say you kept this $58,000 in a cash savings account, or even in individual brokerage accounts. So you open an account in E-Trade, you put 58,000 there instead of your SEP. Well, every year that your investments pay you dividends and capital gains, you pay tax on that. When you have your money in a retirement account, all the interest and dividends and capital gains grow tax deferred. That means that with the time value of money and compounding interest, you have more earning power in a retirement account than you do in an individual brokerage account. There's no real fees to set it up. There's maybe an annual fee to maintain it. They're very easy to set up. And what I talk to my clients about is, don't wait until April when your accountant tells you, here's how much you can fund into your SEP. If you're keeping track of your business profit like you should, you roughly know about what 20% is. And nothing is preventing self-employed folks from making monthly or quarterly or any frequency of contribution into your SEP. It doesn't have to be done all at one time when you're doing your tax return or when you file an extension to fund your SEP. So put money in on a monthly basis or on a quarterly basis. And then that cash flow is alleviated in April when your accountant does tell you, all right, here's your net Schedule C. You are eligible to contribute $32,000 into your SEP. Well, you've already put in 28 because you were tracking your profit all year. Jump in if anybody has any questions about a SEP IRA. I'll add this, that even in a year where, and I went through this personally, last year felt very uncertain. And I thought, well, I want to hoard my cash. I don't want to put money into my retirement because what if I need it? You can't undo a tax year and go back and decide to put money in later. Retirement, the tax code around all retirement plans is it's limited on an annual basis. So once you file your tax return, you can't change your mind and put money in. And 10, 20, 30 years from now, you're not going to regret funding your retirement account. So I personally, kind of go through this balance every year, but the accountant in me wins out and I contribute. I advise all my clients to do this. And once you have a big balance built up in your Roth IRA, let me pay attention to the time here. I'm pretty much wrapping up. We trust real estate. I know I'm very risk adverse. All of us here are in real estate because we like real estate. We trust real estate. Your retirement accounts can own real estate. You can convert your SEP IRA or your 401k into what's called a self-directed IRA and buy rental property that is held within that IRA account. And now you've really diversified your retirement portfolio with brokerage, stock, and real estate. I will wrap that up with the caveat for any other follow-up questions here that a lot of times my answer is it depends, because I don't see your entire tax situation and there's a lot of calculation that go into, sometimes you think you're asking one question, but there's a lot that kind of goes into that answer. So any questions that you've had in everything that I've covered?
Question, please. So can you throw a little bit more light on the self-directed IRA? Self-directed IRA.
Sure.
And for real estate specifically.
So anybody can do this. Sorry, there's still feedback. Oh, thanks, Patrick. Anybody with a balance that has a balance in a retirement account, whether it's a 401k, an IRA, or SEP IRA, the mechanics of it are you have to initiate a rollover to what's called a self-directed IRA. So you find your account administrator who handles the self-directed IRAs, and then you acquire property in the IRA. There is no commingling. There is no money transferred back and forth. You are not taking the rents out. Every transaction, every cash flow, everything stays in the IRA, just like your 401k. You're not taking, the dividends of your investments out of your 401k. So it is still hands off until you reach retirement. A self-directed IRA can take on debt. So let's say you have a $200,000 balance in a SEP IRA account. You could take, I don't know, you can even go out of the area, out of market, go out of state. You can put, I don't know, 50% down on 3 properties and take on debt for the rest of it. And the account maintains the payments, the rents and the cash flow stay in the account. It is a great plan to, as long as they cash flow, which means, you know, a big down payment, a market where, you know, rents are stable. So it requires research just like it would, you know, acquiring a rental property outside of retirement. But it is a way to diversify your retirement and grow your portfolio with something real and tangible. I think this alleviates fears for folks that what if the market crashes and my retirement, you know, takes a big hit. It's an asset, it's a house, so it's not going anywhere. It will still be able to be rented even if the market goes down. So a lot of people like this as a way to diversify and feel a little more confident in an industry that we know and trust.
Supplemental question, please.
Andrea.
Supplemental
Sorry,
question, please.
no problem.
Sorry. So thank you for answering that. Just one more question. So can this be used as a strategy for someone who is at that age group where it is closer to retirement?
Sure, I would say if the cash flow makes sense, because you want to work with your retirement plan administrator to look at the cash and the annual distribution that's available, having it invested in the market versus replacing that with real property, making sure that it cash flows. So it's that I would say is, you know, take some research.
Got it. Thank you very much.
Yeah.
Very much.
Andrea.
Yeah.
So a Roth IRA, I could basically take some of that money, convert it, use $50,000 of it, buy a home, use that as the down, and now everything that it generates by that home goes into that IRA. And Vasu, great question, because I'm late in the game to retirement. So that's, you know, as long as it cash flows, it should be, it's a safe investment. I mean, it's real estate, you know, better than the stock market, better than anything. They're not making any more land, right? So, and I had one other question that might not be, but what if you pulled out a distribution? Let's say you've got a Roth, money's tight, the last year things dried up, and you've pulled $20,000 out of your, are there penalties? Do you see any type of relief or breaks that the government might be offering for you pulling that distribution out early in order to keep your boat afloat?
There's a few answers to that question. First of all, with a Roth, because that went in with after-tax dollars, some of your contributions will come out tax-free. So a Roth has a unique feature there where you can take some of it out without paying tax on that. Other retirement accounts, the government did create some relief last year for withdrawals from retirement accounts if you could show real hardship from COVID. Someone in your family was ill, someone lost their job, you had to show real hardship, and then they relieved the 10% early withdrawal penalty, still subject to ordinary income tax. If you took it out as a loan, you can repay it, and part of the COVID relief was that you can repay the loan and recharacterize and get back some of the tax liability if you did take a distribution. So there's a lot of nuance to that answer. Unfortunately, I don't have a straight answer for you there. Roth IRA are great accounts. They're limited to $6,000. With a SEP IRA, I was thinking about continuing to fund Roth versus SEP. Sorry, I went on a little diversion there. So yeah, if you can't show hardship, the distribution will still be subject to tax, ordinary income tax rates, plus the 10% early withdrawal penalty. On the Roth, a little bit different calculation. I see Robert joined later in the session. Hi, Robert. And any other questions from Henry, or was that Stacy? Sorry, your name's hidden.
it doesn't look like it. But thank you for your time, Andrea. It's always great. You gave us like a bonus section on top of Prop 19. And I think it was excellent information, especially for the newer agents. So thank you for doing that. And I will recommend all of you guys, especially the new ones, it's very important to have your team, the people that are on your team, you know, your escrow team, your attorney's team, and Andrea is a perfect person to add to your team. So if you don't already have an enrolled agent, a CPA on your team, take down her information. I promise you, you will need it either for yourself or for your clients. And it's just so convenient to have somebody in your speed dial and just somebody that you could count on and rely on. And she is somebody that's given you her time and her knowledge today. So we always want to take care of the people that take care of us.
Thanks, Angel. Basu?
Yes, hi. Thank you so much for all this information. So one question. So what would be a good number for who's considered HNI?
I'm sorry, can you repeat the last part of that question?
So what would be the value you'd put at high net worth individual or investors?
Oh, so that answer is different. When I was at the firm after college, they said $10 million of liquid assets as high net worth. Some
Okay.
investment advisors, they won't take clients on without $1 million of liquid assets. So it's not just the value of our real property. They want liquid assets, brokerage accounts,
Good.
retirement accounts. I want to add something to what Angel said, having people in your resources for your clients. If you have sellers that are in or potentially could be in a taxable capital gain position,
Yes.
instead of just saying consult your tax advisor and you have no idea if they do or not, I work with agents to put together a projection for their clients so that you know they've been given the number and the knowledge of their tax liability and exposure. And I'll share a quick story here that I worked with an agent referred me her client. She sold her family home in Willow Glen. She lived there for almost 30 years. Big capital gain, right? A lot of equity.
Yes.
She took all of her equity, put it into the next property, truly took all of her proceeds out of escrow, put it down on the next property, and didn't set any money aside for her income tax liability. So she had money in retirement that she was able to liquidate and raise to pay her tax bill. But that is an extremely cautionary tale of, don't just tell your clients to seek tax advice. We can work together and put together a projection for them.
Got it. So one supplemental question. I seem to come up with a lot of those. So because some of the clients that I want to pursue would be in that bracket who are planning for that huge capital gain tax bill for their transactions as they're going on building wealth. So what would be where would I draw a line between just go seek out your CPA and tax consultant versus this could be one strategy? Why don't you explore that with your CPA? So can you kind of shed some light on that, please?
Yeah, so a quick way to just quickly assess is look at what they paid for their property and look at what you're going to list it for. And if that is more than $500,000 of equity, they have exposure for capital gain.
Capital gains.
I've heard some agents say, well, we're listing it at 1.2 and their mortgage is 900, so they don't have a gain. Mortgage balance does not have anything to do with that calculation. It is their purchase price. So purchase price, is the delta there to find their equity. And if it's more than $500,000, which is a married Section 121 personal gain exclusion, then they should be talking to someone about potential capital gain consequences.
Got it. So mortgage doesn't play any role in the capital gains calculation?
Nope.
Okay. Thank you so much.
Thank you. I'm gonna jump off, everybody. Angel put my information in chat, and Angel, thank you for bringing all of us together. And you have Angel always has a lot of resources too. So if you need my contact information or other information, reach out to Angel. Thank you, everybody, for your time.
Thank you, Andrea.
Thank you, Angel.
Thank you,
Bye,
Angel.
everybody.
Thank you.
Have a good day.
Thank you, you too.
Thank you.